Imagine building a digital product that is used by nearly 1 billion people every single month.
I mean, that's just a staggering number.
Right. You reach almost every teenager and young adult on the planet. People are opening your app like 40 times a day.
Yeah, the engagement is off the charts.
And yet Wall Street is pounding on your door, looking at your financials, and telling you that your company is practically worthless.
It's crazy.
That is the exact nightmare Snap Inc., the creator of Snapchat, is waking up to in early 2026.
It really is the ultimate paradox of the modern tech era because gathering a massive audience used to be the only metric that mattered.
Right. If you had the eyeballs, you were golden.
Exactly. But now, the market is just brutally punishing companies that can't extract, maximum financial yield from every single tap, swipe, and message.
So we have a really fascinating stack of sources today to figure out exactly what is happening behind the closed doors at Snap. We're looking at their official Q4 2025 and Q1 2026 earnings materials.
Which are super revealing, by the way.
Yeah, absolutely. And along with that, a frankly brutal public presentation from an activist investor called Irenic Capital Management.
Oh, that letter is intense.
It really is. We also pulled financial valuation models from AlphaSpread, an eye-opening report from TubeFilter on their massive creator monetization overhaul. And to gauge the raw market sentiment, we've got direct discussions from retail investors on Reddit.
Which is always where you get the unfiltered truth.
Exactly. So our mission for this deep dive into the sources is to unpack a central glaring mystery. How can a platform with nearly 1 billion active users and skyrocketing subscription revenue be trading at a fraction of its IPO value?
And maybe more importantly, what drastic, unprecedented measures is management taking to save the ship?
Okay, let's unpack this. Because to understand why Snap is in this high-stakes battle right now, we first have to look at the underlying math of their revenue engine.
Yeah, the underlying math is completely inverted over the last 3 years. I mean, the traditional social media playbook was built on a very specific foundation.
Gather infinite free users.
Right. Gather them up, track their behavior across the internet, and then sell that highly targeted data to advertisers.
The classic growth at all costs era. But looking at the data from Snap's recent earnings calls, specifically, the Q4 2025 and Q1 2026 outlook that Court summarized, they are aggressively moving away from that.
They really are.
Snap just crossed a milestone that genuinely surprised me. They hit a $1 billion annualized revenue run rate purely from their direct revenue category.
Which is, that's a phenomenal achievement for an app that was previously entirely dependent on volatile ad budgets.
Totally.
And it's crucial to break down what that metric actually means for you listening and combing through these financial sheets. An annualized revenue run rate doesn't mean Snap has $1 billion of pure profit just sitting in a bank account today.
Right. It's not cash on hand.
Exactly. It's a momentum metric. It means they took their most recent, highly successful period of direct revenue, which is driven primarily by 25 million people paying $3.99 a month for Snapchat Plus, and they projected that current performance forward over 12 months.
And people are paying real money for those premium tiers, like Lens Plus, Platinum, and memory storage plans.
It's actual recurring revenue.
But here is the friction point I found when cross-referencing this with the Reddit retail investor sentiment. While the corporate narrative is, popping champagne over 25 million subscribers, the retail investors are pointing at a terrifying leak in the hull.
Yeah, the DAUs.
Right. North American daily active users, or DAUs, declined by 5 to 6% year over year in Q4. They are down to about 94 million users in that specific region.
And the Reddit community's fixation on that specific geographic decline is entirely justified. Because in the programmatic advertising ecosystem, not all users are created equal.
Not even close.
Historically, a North American user commands an astronomically higher cost per mil, or CPM. They are generally about 3 times more valuable to an advertiser than a European user.
Wow.
And a staggering 10 to 15 times more valuable than a user in the rest of world category.
Okay, let me put an analogy out there to visualize this ad bidding math, because I think this is key.
Go for it.
Instead of thinking about it like a nightclub losing foot traffic, let's look at Snap's ad space like a high-end auction house.
Okay, I like that.
For years, the front rows were packed with extremely wealthy bidders, the North American users, driving the prices of the art up to premium levels. Now, those wealthy bidders are quietly leaving the room.
Right.
The auction house is still packed with people from all over the world, but they only have a fraction of the budget. So the auctioneer has to sell 10 or 15 times the amount of art just to make the exact same revenue they did yesterday.
That perfectly illustrates the pressure on Snap's algorithmic ad engine. I mean, when you lose that high-margin North American audience, your sales teams and your back-end infrastructure have to work exponentially harder to maintain flat revenue.
It's a treadmill.
Exactly.
Right.
And this is fundamentally why the pivot to subscriptions is a matter of survival, not just an expansion strategy. Advertising has become a brutal, low-margin grind.
Especially with Apple.
Yes. Apple's app tracking transparency changes essentially blinded platforms like Snap. It made it incredibly difficult to prove to advertisers that a specific ad led to a specific purchase.
By contrast, subscription revenue completely bypasses that entire tracking nightmare. Once a user subscribes, that is recurring cash flow immune to whatever privacy changes Apple or Google implement on the operating system level.
It's safe money.
And it proves something profound about the product itself. Snapchat has deep utility value. People aren't paying $4 a month just to doom scroll more efficiently.
No, they're paying for features that matter to their daily communication habits.
Like pinning a best friend to the top of their feed or customizing a Bitmoji pet.
Yeah, it enhances their intimate digital relationships. It's an incredibly sticky product. But this is where the narrative violently splits.
The disconnect between the product's cultural relevance and the company's financial reality.
Exactly.
Let's look at the financial models from AlphaSpread. Snap's enterprise value to EBITDA multiple is sitting at negative 29.6. Yeah. Now, for the market watchers listening, the industry average for healthy tech platforms is a positive 11.4. The stock has been languishing between $4.50 and $6, which is, miles away from its $17 IPO price.
A multiple of negative 29.6 is mathematically disastrous. To explain the mechanics of that, EV to EBITDA measures a company's total value against its core operational cash flow.
Right.
A healthy positive number, like the industry average of 11.4, means a company generates enough operating profit to theoretically cover its entire value in about 11 years.
Makes sense.
When that number is deeply negative, it means the core operations are structurally unprofitable. The engine is burning cash just to keep the lights on.
And the market is only assigning it any enterprise value based on speculative future growth, or I guess the sheer liquidation value of its user base.
Exactly. And enter Irenic Capital Management.
Oh, boy.
Yeah.
Oh.
They own about 2.5% of Snap's Class A shares, and they stepped into this bloodbath with an open letter to Snap CEO Evan Spiegel. They attached a presentation titled, Save Snap Now.
It's ruthless.
Beyond ruthless.
They point out that $1 invested at the Snap IPO is worth about 23 cents today. And they highlight that Snap has underperformed Meta by 477 percentage points since Meta announced its famous year of efficiency.
The demands in that letter are sweeping. Irenic is pushing for massive corporate governance reform so Class A shares actually get voting rights.
Which is a direct attack on Evan Spiegel's iron grip on the board.
Totally. They also demand deep cuts to the workforce, noting Snap ballooned from 3,000 employees pre-COVID to over 5,200, and they insist that employee stock-based compensation be heavily tied to aggressive performance targets.
Rather than just acting as a baseline subsidy for tech workers.
Right.
But here is the specific demand from Irenic that I have to push back on. They are demanding that Snap spin or shut the Specs project. These are Snap's augmented reality glasses.
Yeah, they're AR hardware.
I look at this and see a massive multi-billion-dollar investment. Snap has poured $3.5 billion into AR hardware, and they are burning $500 million a year on it right now. Evan Spiegel has always maintained that AR is the next computing platform after the smartphone. He has. If Wall Street forces them to shut down their main hardware project, aren't we just watching a short-term financial greed destroy a founder's long-term vision? Like, what happens to Snap in 2035 if they kill the very technology that was supposed to liberate them from Apple and Google's App Store monopolies?
Well, that tension is the philosophical core of the entire activist campaign. Irenic's argument is grounded in cold, immediate math, not theoretical future platforms. What's fascinating here is the deliberate rhetorical strategy they use.
Oh, how so?
They praise Evan Spiegel extensively. They call him one of the greatest product visionaries of his generation for building a network with 1 billion users. But their central thesis is a sharp dagger. They say he built a great product, but he failed to build a great company.
Ouch. They're basically saying he treats a publicly traded entity like his own personal, bottomless R&D laboratory.
Precisely. Irenic believes Snap's core assets, reaching 75% of the 13 to 34 demographic globally, should inherently be valued at around $35 billion.
Wow. $35 billion.
Yeah. But they argue that valuation is impossible to unlock as long as management burns $500 million annually on AR glasses that just haven't found a viable mass market. Wall Street wants Snap to stop pretending to be a hardware pioneer and focus purely on ad tech, AI monetization, and margin expansion.
Which brings us to a shocking figure from the letter. Because Snap is heavily subsidizing that AR research, their current enterprise value hovers around $7.2 billion. Iranica calls that a comically small sum.
It really is, relatively speaking.
When you think about it, an environment that has the daily engaged attention of 1 billion young people is the ultimate natural distribution point for artificial intelligence.
Oh, absolutely. Environments with that volume of highly engaged traffic are the perfect beachheads for AI. I mean, Meta proved this. They integrated AI directly into their ad bidding algorithms to drastically improve return on ad spend, and their valuation skyrocketed.
Right.
Ironic is looking at Snap's raw audience numbers and screaming that management is leaving billions of dollars on the table by focusing on physical glasses instead of algorithmic efficiency.
So Wall Street demands cutting the fat, specifically the AR hardware. But Evan Spiegel clearly isn't giving up his passion project. So how do you appease an activist investor demanding better margins without killing your favorite project?
You execute a ruthless efficiency playbook everywhere else in the company.
Exactly. And the way Snap is doing this feels like we've jumped 5 years into the future.
It really does. The April 2026 investor presentation, summarized by Court, outlines a massive operational transformation. Snap is actively pivoting toward profitable growth through deep, systemic cuts. They announced a 16% reduction in full-time personnel, designed to save the company an estimated $500 million annually.
But it's the mechanism of those cuts that really caught my attention. They aren't just emptying desks and asking the remaining employees to work nights and weekends.
No.
They are structurally replacing human labor with artificial intelligence across the entire software development pipeline. The presentation claims that 65% of new code at Snap is now generated by AI.
That statistic fundamentally alters the traditional economics of a technology company.
How does that actually work in practice, though? We aren't talking about a manager typing a prompt into a chatbot and a new Snapchat feature magically popping out. What does an engineering department look like when 65% of the code base is machine-generated?
Well, it's a complete overhaul of the continuous integration pipeline. The AI acts as a deeply embedded co-pilot. When a human engineer outlines the architecture for a new feature, the AI agents immediately generate the boilerplate code, structure the databases, and write the initial unit tests.
That's wild.
And it gets crazier. Snap reported that over 7,500 bugs were found by AI code review agents before the software ever reached a human QA tester.
Wow.
It effectively turns software developers from primary writers into editors and reviewers.
They also noted that AI agents are answering over 1 million customer support questions every single month. So you have a drastically smaller human workforce freed from the mundane coding and customer service tasks, supposedly pivoting their energy toward fast product development.
Right, like pushing Snapchat Plus and Snap Lite. It achieves the margin expansion Wall Street is demanding without sacrificing the speed of shipping new features. But, this aggressive automation has secondary consequences. When AI is writing the bulk of your standard code and finding the bugs, the need for entry-level and junior developers evaporates.
Right. You only need senior architects to oversee the AI output.
Exactly.
Well, I connected some dots between our sources, and it becomes clear that this ruthless efficiency isn't just happening in the engineering bays. It's bleeding directly into how they treat their users, specifically the creators who populate the platform with content. Let's look at the TubeFilter report on Snap's creator monetization overhaul.
Yeah, this was huge news.
They officially killed their famous Spotlight Rewards program.
Right, and Spotlight was originally introduced as Snap's direct competitor to the infinite scroll of the TikTok feed. When they launched that specific rewards program a few years ago, it was a legendary moment in the creator economy.
Oh, people were making crazy money.
They were paying out $1 million a day to users just to seed the platform with vertical video content.
It was a digital gold rush. A teenager could post a funny video of their dog, it would go viral on Spotlight, and they'd suddenly have a massive payday. It subsidized the creation of an entirely new ecosystem on the app. But that era is completely dead now.
Very dead.
The new 2025 monetization program they just rolled out drastically changes the math. To even qualify for a payout now, a creator needs 50,000 followers. That threshold used to be just 1,000 followers.
A 50-fold increase in the barrier to entry completely rewrites the incentive structure of the platform.
And not only do you need 50,000 followers, but you also have to hit 10 million Snap views or 1 million Spotlight views within a strict 28-day period just to get your foot in the door.
It's almost impossible for a normal person.
Oh, and even if you manage to hit those astronomical metrics, the new program is strictly invite-only. They are actively making it incredibly difficult for new independent creators to start earning a living on Snapchat. They are shrinking the payout pool, consolidating the wealth at the very top, and relying on AI to curate the feed everywhere else.
This is a classic progression in the life cycle of a platform. It's often referred to as the financialization of the network.
Okay, break that down.
In the early days, a company uses venture capital to heavily subsidize creators. You pay the middle class to build the network effects and train the users to consume content in a specific format.
Like paying people to post dog videos.
Exactly. But once the network is fully established and activist investors are demanding profitability, you squeeze the margins. You stop subsidizing the middle-class creators, you automate the coding infrastructure, and you focus entirely on extracting rent from the highest-yielding assets.
Snap is essentially running Meta's year of efficiency playbook, but they are applying it to their own user base.
Exactly right.
Meta used AI efficiency to cut a quarter of its workforce and boost operating margins by nearly 20 percentage points. Snap is trying to replicate that financial magic to appease firms like Irenic Capital. But I mean, if the barrier to entry for creators is so high that new talent can no longer monetize, you inevitably choke off the pipeline.
You do.
You're signaling to the market that you only want established, elite broadcasters. It feels incredibly corporate and sterile compared to the chaotic, fun app Snapchat used to be.
It is the harsh reality of transitioning from a product-focused startup to a mature, publicly traded entity fighting for its life against algorithmic competitors. The journey from a founder's raw vision to a disciplined, profitable company builder is often the most painful leap in the technology sector.
So to bring all these complex threads together for you listening, whether you are opening Snapchat right now to send a quick video to a group chat, or you are a financial analyst staring at a stock ticker, Snap is the ultimate case study of the 2026 tech landscape.
It really is.
It is undeniable proof that holding the daily attention of 1 billion users does not automatically equal a healthy, thriving business. You can have a beloved product, robust subscription growth, and visionary leadership, but if your underlying operational margins are negative, the market will eventually come to collect.
And, there is a profound paradox at the heart of this entire deep dive into the sources. Throughout their corporate communications, Snap's management consistently states that their core product, and specifically their booming subscription service, works because it is built around something deeply human.
Right. It's designed for intimacy, family communication, and maintaining close, authentic friendships.
Exactly.
The Bitmoji pets, pinning your spouse's photo to the top of the app, keeping a multi-year Snap streak alive with your best friend.
But contrast that human-centric branding with how they are actually saving the company. If Snap successfully leverages artificial intelligence to write 65% of its software code, deploys AI agents to answer its customer service emails, and relies on automated algorithms to ruthlessly curate a much smaller, elite pool of corporate creators.
Wait, I see where you're going with this.
At what point does the underlying infrastructure of the social network become entirely devoid of human touch? And if AI handles literally every operational mechanism behind the scenes, how will that fundamentally alter the deeply human connection that Snap claims makes its product so valuable to those billion users in the first place?
Man, that is a wild thought to leave on. You open an application seeking an authentic connection to humanity, but the entire environment facilitating that intimacy is a machine ruthlessly optimizing for margin expansion. We will leave you to chew on that one. Thanks for joining us on this deep dive into the sources, and remember, keep questioning the information around you. We'll catch you next time.